Welcome to this in-depth exploration of security analysis, where we dive deep into the intricate world of stocks and bonds, all through the lens of one of the most influential figures in the field of value investing, Benjamin Graham. In this video, we'll break down Graham's approach to security analysis and show you how to analyze both stocks and bonds effectively to make well-informed, balanced investment decisions. Whether you're a seasoned investor or a beginner just starting to explore the financial markets, this deep dive will provide you with the insights, tools, and frameworks necessary to become a smarter investor. First, we'll define what security analysis is and why it's so important. Security analysis, as Graham defined it, is the careful study of investments in order to assess their value and potential. This is key for determining whether a security is undervalued or overvalued in the market. As we proceed, we will analyze how to assess risk, valuation, and performance, both in the context of stocks and bonds. Graham's approach is rooted in conservative investing principles focusing on value, minimizing risk, and maximizing long-term returns. By the end of this video, you'll have a comprehensive understanding of how to apply these timeless principles to the stocks and bonds you encounter. Benjamin Graham's philosophy on investment. Benjamin Graham is best known for his value investing philosophy, which emphasizes a disciplined approach to evaluating stocks and bonds. He advocated for a detailed, data-driven process, one that prioritized intrinsic value over market speculation. His work has influenced generations of investors, including the legendary Warren Buffett. In this section, we'll break down Graham's principles of investing and why they remain relevant today. We'll explore intrinsic value and margin of safety. Graham's central tenet was that every security has an intrinsic value, which is its true worth based on fundamentals rather than speculative market prices. We'll discuss how to estimate intrinsic value using tools like earnings, dividends, and assets. One of the cornerstones of Graham's approach is the margin of safety. This principle suggests that investors should only purchase securities when the market price is significantly below the intrinsic value, providing a cushion against risk. We'll dive into specific examples and case studies of how this principle has worked in practice. The importance of diversification. Graham also stressed the importance of diversification to reduce risk. We'll analyze how spreading investments across various sectors, industries, and asset classes, stocks and bonds, can protect investors from market volatility. Analyzing stocks. We'll focus on how to analyze stocks, whether you're evaluating common stocks or preferred stocks. Stock analysis is a complex but essential part of Graham's approach. We'll break it down step by step, understanding the stock market. Before we dive into the analysis itself, it's important to understand the stock market's role in the economy. We'll discuss how stocks represent ownership in companies and how their prices fluctuate based on company performance, market sentiment, and broader economic conditions. Evaluating stocks. The key metrics. Graham's approach to stock evaluation involves a deep dive into several key metrics, including earnings per share (EPS), understanding how a company's earnings are growing or shrinking; price to earnings (PE) ratio, how to assess whether a stock is undervalued or overvalued based on its price relative to earnings; book value, the importance of understanding a company's net asset value and how it compares to its market price; dividend yield, how consistent and reliable dividend payments indicate financial health and stability. We will explore these concepts in detail, providing examples from real companies to show how to apply them in practice. Qualitative analysis of companies. Stock analysis is not just about numbers. It's also about understanding the business behind the stock. In this section, we'll cover how to evaluate the quality of a company's management, its competitive position in the market, and the sustainability of its business model. We'll also discuss the role of macroeconomic factors like industry trends, regulatory changes, and technological advancements that can affect a company's future prospects. Analyzing bonds. Bonds are a different beast entirely when it comes to investment analysis. Unlike stocks, which represent ownership, bonds are debt instruments issued by corporations, municipalities, or governments. In this section, we will walk you through how to analyze bonds for investment purposes. Understanding bonds. At their core, bonds are promises by issuers to repay the principal plus interest over a defined period. We'll break down the different types of bonds: corporate bonds, government bonds, municipal bonds, and explain the unique risks and rewards associated with each. Key metrics in bond analysis. Bond analysis requires understanding various metrics to evaluate a bond's risk and return profile. Coupon rate and yield to maturity (YTM), how to calculate the yield a bond offers and compare it to other investment opportunities. Credit ratings, how agencies like Moody's and S&P rate bonds and how this impacts the bond's risk. Duration and interest rate sensitivity, understanding how bond prices fluctuate in response to changes in interest rates and how duration impacts risk. We'll also discuss credit risk, inflation risk, and default risk, which are essential for analyzing bond investments. Evaluating bond portfolios, Graham recommended a balanced portfolio of both stocks and bonds to reduce risk. In this section, we'll explain how to construct a bond portfolio that aligns with your investment goals and risk tolerance. Risk analysis and portfolio management are that we've covered how to analyze both stocks and bonds. We'll move on to risk analysis and how to manage a balanced portfolio. Understanding risk is crucial to successful investing, as it allows you to mitigate losses while optimizing returns. Assessing risk. Graham's approach to risk was pragmatic. He believed in evaluating the risks in both stocks and bonds and understanding how those risks balance each other. We'll walk you through the key types of risks, such as market risk, the risk of fluctuations in the broader market; liquidity risk, the risk that an asset cannot be sold quickly at its market value; credit risk, the risk that a bond issuer might default. We'll also discuss how to minimize risk through diversification and asset allocation. Constructing a balanced portfolio. Graham recommended an allocation between stocks and bonds based on your individual risk tolerance and financial goals. We'll discuss how to create a portfolio that minimizes risk while providing adequate returns. You'll learn the importance of balancing growth stocks with value stocks and how to incorporate bonds as a stabilizing force in your portfolio. Rebalancing your portfolio. Over time, your portfolio may shift due to changes in market conditions or personal circumstances. We'll talk about how to regularly rebalance your portfolio to ensure it continues to align with your long-term objectives. Case studies and real-world applications. In this final section, we'll look at several case studies that show how to apply Graham's principles of security analysis in the real world. We'll break down examples from both the stock market and the bond market, showing you how to identify undervalued securities, balance risk, and create a diversified portfolio. We'll use historical data from well-known companies and bond issuers, examining their stock and bond performance over time, and applying Graham's principles to demonstrate how they align with his teachings. Conclusion. Thank you for joining us on this extensive deep dive into security analysis, a deep dive into stocks and bonds. By now, you should have a thorough understanding of Benjamin Graham's approach to analyzing securities and how to apply these principles to both stocks and bonds. Remember, the key to successful investing is not chasing market trends or speculating on the next big thing. Instead, it's about doing the hard work of understanding the true value of securities, minimizing risk through diversification, and sticking to a long-term investment strategy. If you found this video helpful, don't forget to like, share, and subscribe for more in-depth content on value investing, financial analysis, and investment strategies. Feel free to leave any questions or comments below. We'd love to hear how you're applying these principles to your own investing journey.